In 1986, a young Wall Street trader built a hedging strategy for a relatively new asset class called mortgage-backed securities. When interest rates moved against his models, the protection failed. His desk lost $100 million in a single quarter, and he was pushed out of the firm that had made him a star. That trader was Larry Fink. He emerged from that loss convinced that human judgment was no longer sufficient to track the risks of a modern portfolio. He needed a machine to see what he had missed. Today, the company Fink founded manages roughly $14 trillion in client assets. This represents a scale of capital larger than the economies of Germany or Japan, leaving only the United States and China as larger economic forces on Earth. The 1986 failure served as the philosophical blueprint for the firm. Fink shifted his focus away from chasing individual market wins to build a company centered on controlling the models that define risk for everyone else. He called the system Aladdin, built to map every node of danger, replacing human intuition with a mathematical nervous system. BlackRock eventually rented it out. Competitors realized licensing Fink's risk architecture was faster and cheaper than building one from scratch. Aladdin quietly expanded to manage trade execution, performance reporting, and daily operational workflows for rival banks, for global insurers, and pension funds around the world. This infrastructure has become a shared nervous system for global finance. While it protects individual clients, it creates a concentrated point of risk where a single software outage could ripple through thousands of firms simultaneously. When the financial system began to collapse in 2008, the Federal Reserve stepped in to absorb billions in toxic mortgage assets from Bear Stearns and AIG. The government hired BlackRock to manage these portfolios because they were the only firm with the technical capacity to price thousands of individual, illiquid assets that had stopped trading. The Fed called on BlackRock again in 2020. As the pandemic froze credit markets, the firm was hired to operate the government's primary and secondary market corporate bond purchasing programs. This created a structural tension. BlackRock was executing a government rescue while simultaneously managing exchange-traded bond funds that held the exact assets being bailed out. This pattern demonstrates how crises lead to permanent institutional leverage. By becoming indispensable during emergencies, a private firm transitions into essential government infrastructure. While BlackRock is famous for index funds with near-zero fees, its real influence is found in the voting power attached to its massive ownership stakes. Through these funds, the firm holds roughly 5 to 8% ownership in nearly every major public company in America, from the big banks to competing automakers and airlines. This common ownership can blunt market competition. If a single shareholder holds significant stakes in every company in an industry, aggressive competition that hurts one rival only shifts profits to another part of that shareholder's portfolio. Despite the firm's focus on modeling external risk, it has repeatedly missed conflicts of interest inside its own building. In 2015, the SEC fined BlackRock after a portfolio manager steered $50 million into his family's energy company. 8 years later, another manager directed $75 million into a film company that offered his daughter an internship and a role in a movie. The firm also faced penalties for its treatment of departing employees. Over 1,000 people were required to sign agreements that waived their right to financial rewards for reporting misconduct to the SEC. In 2024, a bipartisan investigation found that BlackRock's index funds had funneled at least $1.9 billion into Chinese companies flagged by the U.S. government for military involvement and human rights abuses. The combination of managing government bailouts, running competitor software, and voting in rival boardrooms creates a structural concentration of power where conflicts are inevitable. Resistance to this concentration of power has emerged from Republican state governments. Since 2022, several states have pulled billions in public pension assets out of BlackRock funds, citing concerns over its climate and governance commitments. In late 2024, Texas Attorney General Ken Paxton filed an antitrust lawsuit against BlackRock, Vanguard, and State Street. The suit alleges that holding massive stakes across the energy industry while pushing shared climate goals functions like an illegal cartel. The states argue this coordination suppresses coal production and artificially raises energy prices. While Vanguard settled the case by agreeing to limit its shareholder influence and exit climate coalitions, BlackRock has chosen to fight the lawsuit in federal court. A loss at trial risks a court-ordered restructuring of the firm's business model. It could legally mandate how index funds vote and exercise power, potentially dismantling the architectural foundation of the entire industry. Can any government actually break up or meaningfully punish a company of this scale? BlackRock spent 4 decades becoming load-bearing. Breaking the company apart would risk crashing the pension funds and retirement markets that regulators are tasked with protecting. This dependency is not a conspiracy. It is the result of a firm successfully making itself essential to the daily operation of the global economy. Once a corporation becomes structural infrastructure, regulatory fines lose their deterrent power. Instead, they function as a predictable operational expense for maintaining the company's current market position. Next time on Strategy Lens, we examine a different kind of untouchable company, one that avoids regulation by arguing in court that its millions of workers legally do not exist. That is the story of Uber.